Welcome to the Wharton Global High School Investment Competition Meet the Experts series. I'm Diana Drake, Managing Editor of the Wharton Global Youth Program. At Wharton Global Youth, we use the opportunities of the Wharton academic community to educate, inform, and inspire high school students to explore business and finance and embrace their leadership potential. We are always excited to see how far our Wharton Global Youth community reaches around the world. So before we get started, please let us know in the chat channel where you're joining us from today. Always great to see everyone from all over the world. Welcome to all of you. Meet the Experts is a series of video conversations featuring Wharton finance and business experts. While these interviews created specifically for the investment competition are not designed to give student teams a competitive edge, they're a great way to learn from today's professionals about emerging and thought-provoking finance themes, like gender lens investing, fintech, global markets, and more. I encourage all of you to post questions at any time during the event using the Q&A panel on the right-hand side of the screen. Following our prepared questions, we will leave plenty of time for you to ask questions about today's topic or anything finance related. Please keep those questions coming and start them early. All right, let's get started with today's guest. The COVID-19 pandemic has caused great individual and economic instability, and yet the stock market has continued to break records. The current disconnect between the stock market and the economy generates a lot of interest and a lot of questions. So here to answer some of those questions is Wharton Professor of Economics and coordinator of the PhD program, Itay Goldstein. Itay, thanks for joining us today. Professor Goldstein has been on the Wharton faculty since 2004 and is an expert in the areas of corporate finance, financial institutions, and financial markets, focusing on financial fragility and crises and on the feedback effects between firms and financial markets. His research has been published in top academic journals. He earned his PhD in economics in 2001 from Tel Aviv University. Thanks so much for being here.
Thank you.
All right, so we're going to jump right into our questions. So much of what we are going to discuss today is taken from a presentation you created called The Stock Market and the Economy. And I'm wondering, has this been a focus of your research, especially during the pandemic?
Yes, for many years I've been interested in the relation between the stock market and the economy. We usually think about how the stock market reflects the economy. For many years, I was also interested in how the stock market affects the economy. But these issues became particularly interesting during the pandemic, in particular when we saw the stock market continuing to do well when everything else seemed to go badly.
Yes. Yeah, and speaking of, it really has been a rich time for research and for many, especially in the academic community, kind of a big experiment, right? You have a lot of data to draw from. COVID has caused a lot of economic strife globally, impacting supply chains, employee wages, and businesses' ability to operate. During quarantine, the economy all but shut down. We'll be feeling those effects for years, and yet the stock market has continued to trend upward and break records. So can you give us your own snapshot of the economic and stock market landscapes over the past few years? How do you characterize both, and what, based on your observations, has been the financial impact of the pandemic in these areas?
So there is a lot to unpack here. The stock market has been doing quite well for many years now. Occasionally it goes down, but then it recovered pretty quickly. So I would say if you look since the aftermath of the global financial crisis of 2008, it has been overall doing quite well. When the pandemic started, I think there was an expectation that the economic shock is so severe that the stock market will decline significantly and will take a long time to recover. It did decline quite a bit if you go back to February and March of 2020. But I think to the surprise of many, it recovered very quickly and continued to go up and break records since then. So we saw during the peak months of the pandemic, we saw what many people thought of is a disconnect between the stock market and the economy, where the economy seemed to be in trouble, but at the same time, the stock market continued to go up and do well.
So what's going on then? Why generally is there this disconnect between the stock market and the economy?
That's a great question, of course.
Another loaded question for you.
Yes, and I would say that there are four channels at work. And this was the topic of my presentation that you referred to in the beginning. I can briefly say what those four channels are, and we can then maybe dive into more details. One channel is that the stock market is forward-looking. So while the pandemic affected the economy at the moment, the stock market is already looking ahead. And if there was an expectation that the pandemic is temporary and things will go back to normal, the stock market was already pricing that in, and as a result, it wasn't affecting the stock market as much. A second channel is that the Federal Reserve in the United States and other central banks in other countries stimulated the economy, reducing interest rates and injecting liquidity, injecting money into financial markets. They helped push prices up. A third channel is that the stock market is not the economy, and as a result, there are sectors in the economy which are not reflected as much in the stock market, and sectors that are not as important in the economy but are reflected quite a lot in the stock market. And this is a reason for a disconnect. And then a fourth channel is what we call the usual bubble dynamics, where we do see in history periods of time when traders in the financial market continue to buy assets even though they might be overvalued. And the reason there is that even though they might be overvalued, you can still make a profit in the short term by continuing to invest into a bubble.
Interesting. So as you have been analyzing this disconnect, can you give possibly an example of kind of a company that you've seen go in a certain direction, or something that emerged during your research that you feel illustrates these channels or illustrates some of the points that you're trying to make?
Yeah, so I can maybe dive into the first channel that I mentioned, which is that the stock market is forward-looking. And one thing that we did see very clearly during the pandemic is that some sectors of the economy that were particularly hit by the pandemic and for which there might have been a permanent change in the business model and in the potential for profitability, they did see price decline. So you did see that in, say, the travel industry and some of the other services. However, on the other hand, when you think about more the high-tech, the technology, telecommunication, things like that, those industries actually did fairly well and tend to benefit from some of the developments in the pandemic. So that is an illustration of how the stock market could be forward-looking, pricing ahead some of the changes that it anticipates to come down the road. On the other hand, I mentioned another channel, which is the so-called bubble dynamics. I think we see that nowadays really across the board. We see bubble dynamics in stocks like GameStop, AMC. Those were stocks that were really in the headlines for a while because you basically saw stocks with limited potential. Those are business models that faced some serious headwinds, but still the stock prices went up dramatically for a while. And I would say this was really a classic example of bubble dynamics. People are investing in assets that seem to be overvalued by all common metrics, but they still do that, and they can still make some short-term gains by doing that.
Right. But of course, our investment competition is looking much more long term. Our teams are charged with thinking about building the wealth of a potential client over the long term. And so, those types of GameStop stories, while enticing and interesting, are definitely outliers from what we're trying to push with our competition. But I know one thing that you addressed in your research is, at the end of the day, does the stock market play an active role in the real economy, or is it just a sideshow?
Yes, this is really one of the most interesting questions when you think about financial markets. One of the most hotly debated questions, I would say. If the stock market is just a sideshow, it makes a lot of what we do less interesting and less important. Because, if it's just reflecting the economy but not affecting the economy, then yes, maybe there is room to make profit and so on. But at the end of the day, it is a footnote, or as we said, a sideshow. I tend to believe that this is not the case. I tend to believe that the stock market does have an active, real effect on the economy. And over the years, I engaged in research, providing evidence and mechanisms through which this happens. I would say that there are two key mechanisms, I would say, through which the stock market affects the real economy. One is that when stock prices go up, firms in many ways become richer because with a high stock price, they can raise capital more easily. We mentioned GameStop and AMC sort of as anecdotes a few minutes ago, and they're actually examples of how when stock prices go up, firms can do better just because they have higher stock prices. So even in those cases, AMC, that it seemed like it has limited potential to grow, they were actually able to use the higher stock prices and raise capital in the financial market in attractive terms that allowed them to pay back their liabilities and avoid bankruptcy. This was, at the end of the day, a bit of a self-fulfilling belief of the stock market that enabled them to get out of the difficult position they were in. So this is really an extreme example, but it shows you how when the stock market is higher, you can have a feedback effect on the firm that allows it to raise capital, raise money in more attractive conditions and do better. The second channel through which the stock market, I think, affects the real economy is through information. And this is a little more subtle, but I think is quite powerful. The idea here being that the stock market at the end of the day reveals signals, reveals information to people in the real side of the economy making investment production decisions and guides their decisions along these lines. So if I am a manager and I see that that I announce, we are going to make this big investment, and then the next day the stock price decreases, this is basically a vote of no confidence from the market in my investment plans that could make me reassess, reevaluate, and potentially change the decision. And we see examples along these lines along the way. For example, very recently, there was an announcement that PayPal is going to acquire Pinterest. And the stock market did not like it and responded very negatively. Stock price went down. A couple of days later, they basically said that they decided not to do it. So, it's always interesting to see these anecdotes where the stock market sends you a message and you change your behavior accordingly. My research has indicated that those things are happening a lot more often, and firms really tend to change their investment decisions and investment trajectories following information that they get from the market.
So why do you think they're doing it more often? I mean, is it because investors are having more influence over their decision making at the end of the day?
Yes, I would say yes. I would say, at the end of the day, the stock market is really a way to get objective, unbiased signal message in many cases. At the end of the day, when you think about managers having to make a decision, they have limited information. It is true that they know the firm very well. They have access to data about the firm. They have access to projections. But remember that they need to make a lot of assumptions about how things are going to develop and how their investments are going to materialize. The stock market gathers and aggregates information from many different participants in the economy, and as a result can serve as a way to judge whether your decision, whether your plans are actually making sense, or maybe you should reevaluate them.
So back to this disconnect between the stock market and the economy that we were discussing. Our students are doing lots of analysis right now. They're figuring out which companies to include in their portfolios, and they're developing investment strategies. So for students doing analysis and trying to figure out what stocks they want to choose, what advice would you give to them about how to consider the economy in their decision-making process?
So there are multiple ways to do that. One thing to think about is to compare the price of the stock with the underlying fundamentals of the firm. And for this, in finance, there are well-developed financial ratios, like the PE ratio, for example, on its various versions, that basically compares what is the price to what are the earnings, and is a tool that enables you to make a judgment on whether the price currently is too high or too low. And if it is very high, then maybe you can come up with some reason for why it is high, and sort of dig deeper to see whether there is a way to justify it. In the broader level, I would say that when you are analyzing the stock market and thinking about the economy in order to make investment decisions, you should really think about industries. Which industries are expected to do better in the current economic environment? A couple of examples here. We are seeing that technology firms, for example, have done quite well. And there are reasons to believe that there is room for more technological innovations down the road, and that those technologies are going to be needed in the direction that the economy is now taking. So there is a reason to be optimistic about them. And another example is with ESG, which is environmental, societal, and governance factors, which are generating a lot of attention in the investors' community, and are affecting the prices of firms. So I think that going forward, firms or industries that are investing more in green technologies and are maybe more tuned to the needs that we have in the climate change, I think that they have the potential to potentially do better. So I think it's important to, first of all, analyze the fundamentals of each firm on its own, comparing the earnings with prices and seeing whether there is potential for growth and whether you can justify the high prices. But there is also room to sort of do more analysis at the industry level and try to make a decision on which industries you think have more potential as the economy develop, and which industries have less.
Okay, great. So we do have a couple questions from our viewers, and I encourage you all to post your questions for Professor Goldstein. The first one is a follow-on from what we were just discussing from Caitlin. Are there any resources that you would recommend for monitoring the growth of an industry?
So there are many resources these days. In our information era, you basically go online and you find a lot of websites that allow you to do a lot of analysis on the development of individual firms and also industries as a whole. I can mention Bloomberg as an example, which contains a lot of information on different firms across industries. But even others, like you can find a lot of information in finance.yahoo.com and others that allow you to do a lot of fundamental analysis on different firms and different industries.
So this is interesting because I wanted to ask you a little bit more about trends that you've been seeing. Liran wants to know, has the pandemic encouraged more people to think about investing in the stock market? And perhaps that's one of the reasons why we've seen the stock market go up. He's curious to know whether or not it's had any influence on activity.
Yes, that's a very interesting question. I believe it did. And I believe that there were a couple of factors in play here. First of all, this was not a direct result of the pandemic, but coincided with the timing, is that there are now tools that make trading easier. And in particular, one platform that got a lot of attention is Robinhood. That really came into prominence fairly recently, and it all sort of became clear around the pandemic in the way that they allow people to trade in a much more friendly way than previous platforms enabled them to do. So certainly the availability of a tool like this allowed more people to get into the stock market and trade different things in the stock market. Second, I do think that the pandemic changed the lifestyle of many people in a very direct way. All of a sudden, a lot of people were at home, had more free time. Some people, not all, but some people even had more money to spend, either because they got some of the assistance from the government, or because they didn't lose their job, but they didn't have that much to spend on because they just stayed at home. So all of a sudden, you did see various people, having the time, having the money, and looking what to do with it. And the stock market was sort of an attractive path for them to go. So I do think this indeed directed some people towards the stock market. And the third thing is just the fact that it was on the news all the time. We keep hearing about things like GameStop and AMC that I mentioned before. And then people see that others are making profits there and thinking, maybe I should do the same thing. Another thing that we didn't mention so far, but it is very popular these days, is the whole space of cryptocurrencies, things like Bitcoin, which is the most famous, but also others that also have this tendency to create what we call the fear of missing out. Prices are going up, you hear other people making good profits on that, and then you are drawn to it as well. I always say, you have to be careful there because it does look a bit like a roller coaster. It goes up, it goes down. But I do think that all the attention certainly drew in more people and attracted more people to take a look and try it.
Absolutely. I mean, crypto is definitely a cautionary tale, but it's a topic that a lot of people in our audience are enamored with. So I'm glad you brought it up. And also, I wanted to go back to something you said about Robinhood and the accessibility of the stock market or of investing because of it. How do you feel about that? Just kind of this barrage of new financial technology that's really making it easier for all of us to jump in and become investors. What thoughts do you have about that?
So I have mixed views on that overall. I mean, at the end of the day, as economists, we are always trained to think that when you remove transaction costs and frictions, things can become better. So the idea that more and more people can sort of have access to the stock market is certainly a positive development. However, on the other hand, I am worried from what I see around that it does tend to attract people who are not experienced with the stock market, might not fully understand what the implications are, and as a result might end up investing in things that are really prone to losses. And I think that cryptocurrencies is certainly an example of that. The so-called meme stocks that we discussed before are also an example of that. So there are, I believe, at the end of the day, some problems associated with making everything so easy, making it look in some sense like a game. There is this idea that what they're doing is gamification of the stock market. So it becomes more like something you do for entertainment than something that you do for investment. And when this happens, I think there could be some regrets down the road.
Absolutely. So this is something that we hear a lot from student teams who are competing and have over the years. Sometimes we're always pushing this idea of long-term investing, right? Not kind of buying and selling very quickly, but rather thinking 10 years out. And I'm interested to know what you would say to how much an investor should incorporate kind of economic expectations or what's happening in the economy now into their long-term investment plan or into their strategy. There's so much happening right now with the pandemic. And, of course, we've been through a lot of political issues in the U.S. and it's hard to kind of figure out how to bake that into your long-term thinking. And I'm wondering what you would say to that.
Yeah, we tend to think that in the long term, there is a benefit to putting your money in the stock market and leaving it there, not taking money out and putting money back in with every twist and turn of the economy. So certainly there is a lot to be said for long-term investing. The stock market has shown that in the long term it can be quite resilient, and people who keep their money in the stock market in the long term can make very nice returns. Having said that, it is always good to keep an eye and do some analysis on particular industries and maybe trends in the economy and make adjustments in your portfolio as a result of that. If you believe that you can come up with insights that allow you to make good decisions. But certainly there is, you should not just take your entire investment out of the market when things turn badly and then put it back in, because it's very difficult to time the market, and when you try to do that, you probably end up losing more than you're gaining.
Okay, we have time for maybe one more question. Vyacheslav wants to know, the market is growing very actively right now, and this raises doubts about the reliability of the exchange. Where do you think this heated market will lead? That's a good one to end on. You can get out your crystal ball.
Yes. Well, the market is very high, and I said that from the beginning, and it certainly gives a lot of us a reason for concern. When you look in history, when the market went to those high levels, there is a high risk that it ends with a crash. And if not a crash, then maybe a major correction. I think it is a possibility. I think asset prices right now are high. They are, stock prices are high. You have those cryptocurrencies which are priced high as well. Real estate is high, bonds are high. So it's like prices across the board are high, which is a combination of the fact that there is so much speculation around the stock market, of the loose monetary policy. Certainly there is risk right now in the market.
There is risk. A great note to end on. All right. Well, thank you very much, Professor Goldstein, for joining us today on Meet the Experts and sharing your insights about the economy and the stock market. We really appreciate your time.
Thank you. I enjoyed it.
So this concludes our 2021 Meet the Experts series. You can view all the interviews on the investment competition website and on our YouTube channel. And also, if you are enjoying the investment competition and are interested in learning more about the other educational programs and courses that Wharton offers to high school students, please join our informational webinar on Tuesday, November 16th from 7 to 7:45 p.m. Eastern Time. You can learn more about our extensive portfolio of high school programs, including on-campus, online, and for-credit opportunities offered during the academic year and the summer. So we look forward to seeing all of you there, and we will be answering your questions. On behalf of our investment competition team, thank you for joining us today. We hope you enjoyed this year's interviews and gained some new knowledge. We're grateful to be a part of your learning journey. Keep up the great work on wins and keep building those great unique strategies. Thank you, everybody.